Imagine your family bank, older than your grandparents, vanishing overnight. Poof. One day it's a place where your parents keep money. The next day it's gone, and everyone's piggy banks are suddenly suspect. That image feels like a story from a movie. But it helps. The 2008 financial crisis is a real-life version of that trick, and we're going to explain it to you as if you were a child, using billboards, game shows, Jenga towers, and boxes of fruit. Start with the billboard. After the early 2000s, leaders of the economy cut interest rates to make borrowing cheap. Imagine a gigantic sign on every street that said, "Why rent when you can own?" It became a slogan you saw everywhere. Houses stopped being just places to live and started being pieces in a gold rush. If you could borrow money for almost nothing, why not buy a house, fix it up, sell it for more, and make a quick profit? People began treating homes like lottery tickets or trading cards instead of roofs over heads. Here's the part that sounds ridiculous but is totally true. Lenders began to hand out loans like candy. Some loans were regular. The bank checks your job, your income, your credit, and says yes if it looks safe. But then came subprime loans. Loans for people with shaky credit. Even more alarming were the ninja loans. Ninja stands for no income, no job, no assets. Think about that name like a label on a toy that says no batteries required. Mostly nonsense. Lenders would give mortgages without asking for proof of income or solid down payments. That's like selling you a bicycle without testing if the brakes work because you promised to pay later. Why would they do that? Because in the short term, it made money for a lot of people. Mortgage brokers got fees when a loan was written. Banks got to collect payments and then sell the loan. Everyone was paid immediately while the risk, the chance the borrower couldn't pay, was passed along to someone else. This is where the Jenga tower starts to wobble. Now imagine a factory that takes lots of these mortgage loans and packs them into shiny boxes. That shiny box is called an MBS, a mortgage-backed security. Think of it as a cereal box filled with a mix of good and rotten fruit, disguised as perfect apples. Each box contains tiny slices of many mortgages. The idea sounded clever. Spread the risk around so that one bad mortgage wouldn't ruin the whole box. Wall Street didn't stop there. They took these boxes and mixed them into bundles called CDOs, collateralized debt obligations. A CDO is like taking several boxes of fruit, cutting them into pieces, and repackaging them into new boxes labeled premium. Banks then sold slices of those boxes to investors. Some slices were supposed to be safer and got the higher labels. Others were riskier and paid more. The problem was the fruit inside wasn't always fresh. Rotten mortgages ended up in the slices labeled safe, but the packaging made them look nice. Who said the boxes were safe? Ratings agencies. These are firms whose job was to check how risky a thing is and give it a grade, like A, B, or C. But here's the catch. The firms that wanted their boxes rated paid the agencies for the service. It's a bit like paying the referee who is supposed to be neutral. That created a real conflict of interest. The agencies were incentivized to give better grades because they got business that way. So a bundle of mixed mortgages could get a top rating, no-cutty, and investors would believe they were buying something as safe as government paper, even though inside were loans to people who barely had paperwork. If rotten fruit in a shiny box sounds bad, wait. There was an insurance trick that made things worse. Enter the credit default swap, or CDS. A CDS is like buying insurance on a neighbor's house, even though you don't own it. You pay a premium to someone who promises to pay you if that house burns down. That doesn't sound terrible until you realize people were buying insurance on boxes of mortgages they didn't own, and the insurance sellers didn't have to keep big piles of cash ready to pay out. It became a giant web of promises. The total value of these promises ballooned far beyond the actual mortgages, so one default could set off many payments, multiplied through the system. Here's a mini hook. You might think insurance would protect everyone, but when the insurer doesn't have enough money to pay, their failure spreads like a bad rumor. A few clever investors smelled something rotten and bet against the housing market. They essentially bought insurance on those boxes, hoping they'd fail. Wall Street, seeing demand for that insurance, created more and more products to sell it. That amplified the amount of exposure in the system. Leverage made things worse. Leverage is when you borrow more money to make a bigger bet. Imagine playing a game where you can borrow 10 toy blocks for every one you own to build your Jenga tower. If the tower stands, you win big. If it falls, you lose 10 times as much. So we had cheap money, risky loans, fake-sounding safe boxes, conflict-tainted ratings, insurance on things people didn't own, and a mountain of borrowed bets. The tower got very tall. Then the bubble popped. Houses didn't keep going up forever. When lots of homeowners had adjustable rate mortgages with low initial payments, their rates later reset higher. Some couldn't afford the higher payments. Others had been counting on selling the house at a higher price and flipping it for a profit. When prices stopped rising, those plans collapsed. Defaults, people not paying their mortgages, started to increase. When enough mortgages inside those MBS and CDO boxes started failing, the value of the boxes plunged. Banks and funds that held these boxes or that had bet on them lost gigantic sums. Some banks were so entangled they couldn't tell how big their losses really were. Then a dramatic moment. Lehman Brothers, a firm with a long history, failed. It filed for bankruptcy and was not rescued. That was like pulling the center block from the Jenga tower and watching the whole thing start to shake. Would the banks, looking at the damage, stopped lending to each other? Why would you lend money to another bank if you don't know what toxic stuff it was hiding? The credit markets froze up. Ordinary businesses couldn't get loans to run their day-to-day needs. A frozen credit system is like a blood clot in the economy. Governments stepped in because they feared the entire system would collapse. In the US, leaders approved a program called TARP, the Troubled Asset Relief Program, for about $700 billion to buy troubled assets and inject capital into banks. The Federal Reserve cut interest rates and used other tools to put liquidity back into the system. The Fed also launched programs called quantitative easing. Think of quantitative easing as using a giant sponge to soak up extra money and press it back into the economy. Or like the central bank printing digital money to buy safe things so lenders have cash to lend again. The government also provided emergency aid to big institutions like AIG, roughly around $180 billion in emergency support, and later to the auto industry in separate measures. These moves were meant to stop a total collapse, but they also raised angry questions. Who pays when there's a rescue? The people who made risky bets often got help. The homeowners who lost their houses did not get the same kind of lifeline. This is where moral hazard comes in. Moral hazard means if you think someone else will rescue you when you take big risks, you might take bigger risks. It's like a kid on a bike riding recklessly because they think a parent will always catch them. When big firms are presumed too big to fail, their reckless choices end up socialized. The public takes on the cost. Remember the Jenga tower image. When Lehman fell, the tower cracked. Banks stopped trusting each other. The result was human misery. Millions lost jobs, families faced foreclosure, and retirement accounts like 401ks shrank as markets tumbled. Wealth evaporated from households that had once thought their houses were savings accounts. Soup kitchens saw more faces. Foreclosed houses became empty signs of broken plans and dashed hopes. People were rightly furious. You saw it on the streets with Occupy Wall Street, tents, cardboard signs. We are the 99%. That phrase tried to capture the feeling that a few people on top had gotten protective bailouts, while the many suffered wage cuts, lost homes, and reduced life savings. The anger was not just about dollars. It was about fairness and accountability. Why did the system rescue institutions but not people. It's important to say there wasn't a single villain in this story. Greed played a role. So did bad incentives. Regulatory gaps mattered, simple human errors, clever financial engineering, and belief in always rising house prices all mixed together. The crisis was a messy stew, not a single ingredient. Saying only one thing caused it would be like pointing at a single missing block and pretending that explains why the whole Jenga tower fell. So what are the lessons, explained simply? First, if something is being sold as always safe, and many people are being paid to pass the risk along, be suspicious. A box that looks shiny might have rotten fruit inside. Second, complexity can hide danger. When financial products get so complicated that almost nobody can explain exactly what's inside, the probability of surprises jumps. Third, incentives matter. If the people checking safety are paid by those making the product, expect optimistic reports. Fourth, leverage amplifies both gains and losses. Borrowing to gamble makes the fall much harder. And finally, systems that are tightly connected can collapse quickly. One failure can become many. There are practical signs to watch for in any future story. A cultural slogan that sounds like an order. Why rent when you can own? Too easy credit, lots of new products nobody can explain, ratings that seem suspiciously generous, and insurance-like bets that aren't backed by actual reserves. These are the auditory and visual clues of a tower being built too fast. We must also remember the human side again. Behind every abstract number were people who lost homes, whose retirement savings were cut, who had to take lower-paying jobs, or whose small businesses could not get financing. Any explanation that treats the crisis purely as a puzzle of numbers has missed the human toll. Compassion for those affected and insistence on accountability for systems matter together. Could the crash have been prevented? Maybe parts of it. Stronger lending standards would have helped. Better oversight of ratings agencies and of the swelling insurance market could have limited the damage. But that doesn't erase the complexity. Many actors made choices that made sense short-term and disastrous long-term. The safest bet as a citizen is to look for transparency and to demand rules that align incentives with stable outcomes. Think of this story as a cautionary tale, not a prophecy. The same conditions could reappear if systems grow opaque and incentives remain misaligned. But knowing the signs gives you power. When you hear a too-good-to-be-true pitch or see a product everyone calls safe without clear explanation, you can ask simple questions. Who benefits now? Who bears the risk later? Are the people judging safety paid by those they judge? Are those selling insurance really holding the money needed to pay if things go wrong? We began with a disappearing bank and a game show where everyone acts like money is free. End with a clearer picture. The crisis was built on cheap credit, risky loans, repackaging that hid rotten pieces, a web of insurance, and too much borrowing. It collapsed when homeowners couldn't pay and prices fell, and it spread because the system was tightly connected. Governments used big interventions, like roughly $700 billion for TARP, large emergency support to institutions like AIG and the Federal Reserve's quantitative easing, to stop a deeper meltdown. Those interventions stemmed the immediate panic, but also left questions about fairness and accountability. If this quick story is helping, tap like so we can make more Explain Like I'm 10 videos. Keep thinking of the economy as a Jenga tower, a game show, and a box of fruit. Those images make the complex easier to spot. To close, watch for shiny boxes with hidden rot. Question ratings when the rater is paid by the seller. Be wary when insurance is sold on things you don't own. And remember that when systems are tightly linked, a small failure can feel like an earthquake. Most of all, remember the people who lost and carry that compassion into any conversation about policy and reform. Tell us one word. What surprised you most? comment below and subscribe for more simple explainers.